The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A cooler CPI print, not enough to heat up the market rally. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bhatia, kicking you off to the closing bell here in the U.S. on this Tuesday afternoon with financial markets that looked like they were going to open higher, but that higher open faded pretty quickly. The S&P 500 now down about 0.3% here on the day. The rest of the major indices following a similar trajectory, though getting a modest bid once again here in the small cap cyclical space. A lot going on when it comes to the commodity space. Oil climbing to a 2-month high. This after Trump amped up his rhetoric over Iran. Gold and silver at record highs once again. Silver in particular here back above that, at one point I should say on the day was back above that $88 level, now up about 2.7%, just a little bit shy of that. And keep an eye on what's going on with dollar yen, one of the weakest days we've seen for the yen relative to the dollar in quite some time. Some concerns here about some of the next policy moves coming out of the new government in that part of the world. Meanwhile, back here in the U.S., dollar strength is also being aided by the relative softness that we had in the latest consumer price index report. The idea that tamer inflation provides a path for more aggressive rate cuts. But parsing through that data, the economic arguments for easing is still going to be tough. Core CPI, it rose 0.2% in December from November. That's slightly less than forecast, but it's still a core CPI reading that year over year is now above the Fed's 2% target rate for going on 5 years.
It looks like a pretty confusing number, quite frankly. You know, and on top of that, you did have government-related distortions because of the shutdown. You know, so I think the Fed will have to parse through this. You know, the way that we read the, the tea leaves more recently is that after 75 basis points of cuts that they've implemented in the second half of 2025, they're much closer to neutral. They're on the higher end of their own range.
Now, you can nitpick that CPI report all you want, and we're certainly going to do that later in the show. But the consensus in financial markets is that rates will head lower, whether the economic backdrop actually supports it, given the thumb the White House is putting on the scale. Jordan Rochester over at Mizuho put it best, saying it's hard to argue direction on the back of this, especially with politics playing a larger factor for Powell and the Fed. For now, that's keeping the market moves in check, as is a somewhat disappointing start to the earnings season. J.P. Morgan sliding after reporting an unexpected dip in revenue from underwriting and M&A advising. And Delta Airlines, which just 6 months ago was decidedly bullish on its outlook, today gave a profit forecast that fell short of some analyst estimates as geopolitics crimps inbound foreign travel to the U.S. But we do want to kick things off here with a closer look at the state of the economy and a closer look at the policies coming out of Washington. Eric Rosengren joins us right now, former Federal Reserve President of Boston. And Eric, I do want to start off with the general idea of what the Fed can do next, given the economic data that we've seen that seems to suggest a labor market influx, but still stable, and inflation, well, still a question mark, but not necessarily hot as it was just a year or so ago.
Yeah, so I agree with you that the conditions for easing right now are not nearly as strong as they might have been a quarter ago. The CPI at 2.7% is substantially above the 2% inflation target. It was 2.7 last month as well. And if you look at the PCE measure of inflation, it's been gradually rising. So the result is that the inflation news has not been such that you can have a great deal of confidence that the Fed's going to get back to target, particularly as you note, they've missed their 2% target for almost 5 years. On the labor market side, there were only 50,000 jobs created, but that's the average that we've seen over the last year. And part of that is because of immigration. With much less immigration, we don't have as much growth in the labor force. In fact, labor force has been pretty much flat. And so 50,000 jobs isn't that far out of the ordinary, given the slow growth in the labor force. The unemployment rate's at 4.4%. That's very close to what the Fed thinks it will be in the long run. It's a little bit above, but only a little bit above. So I think that the Fed is well situated to wait and see if the economy picks up. There is reason to believe that next year GDP will be stronger. Fiscal policy is going to be stimulative because we're running large deficits. The big, beautiful bill included investment credits that encourage investment and also has lower taxes for helping consumers out. So I think the conditions for reasonable growth next year are there. And so as long as that actually pans out, there's really no reason for the Fed to change the level of rates.
There has been sort of a parlor game going on right now in financial markets. The idea that one way or another, we are going to see more accommodative policy out of the Fed this year, largely because of the political factors here, whether it is the formal replacement of Jay Powell at his expected departure date later this year in May, or maybe potentially sooner than that. But just overall, the idea that you have a White House that seems emboldened in its desire to continue jawboning where it thinks monetary policy should go. Eric, I know I heard from all these former Fed members that say, look, you go into that room, you focus on the data, not the politics going on down the street out of the White House. This just feels a little bit different here in 2026, though.
Well, I agree with the commentators that have said that the Fed tends to focus on the data, but it does matter who's in positions to make the decisions. And so Jay Powell's term ends in May. And assuming that the administration comes up with someone to replace Jay, and it gets that person gets Senate confirmation, the administration's made clear that they're not going to appoint somebody who doesn't believe that interest rates should drop quite significantly, which has been clearly expressed by the president. So I think most of the optimism for interest rates coming down assumes that it's going to happen in the second half of the year. When there's a new Fed chair in place. It's still a committee decision. Whoever gets picked has to have enough credibility and has to have strong enough arguments that he convinces a majority of the FOMC to vote their way. So it's still not a slam dunk, even with a new Fed chair, that rates actually decline, particularly if the administration jawboning and potential legal challenges raise concerns about Federal Reserve independence and make some of the voting members want to be sure that the economic conditions justify a move.
Well, given the DOJ subpoenas into Powell, ostensibly into Powell's handling of the renovations of the Fed building, given the Supreme Court argument scheduled to start next week involving Lisa Cook and the power of the president to actually remove a Fed governor seemingly at will, I am curious, Eric, about this idea of Fed independence and whether we should really start looking at this as the beginning of the end, particularly given the comments out of the three former Fed chiefs yesterday, their statement that they signed, the support today that we saw from monetary policy officials overseas, as well as executives like J.P. Morgan CEO Jamie Dimon.
Yeah, so Fed independence is critically important. Normally, losing Fed independence is something that happens in third world countries, where either they're having trouble managing their deficit and want to get the interest rates down to make it easier to issue debt, or they're trying to get interest rates down because they think it'll help them get elected in the upcoming election. The Federal Reserve was constructed to be pretty independent from the rest of government, so that this kind of political business cycle doesn't actually occur in the United States. So to the extent that various actions by the administration undermine the belief that the Fed will stay independent, it will make harder for the next chair to actually lower interest rates, convince people that they are truly independent, and runs the risk if people start becoming concerned that the Fed no longer is going to focus on inflation, that even if interest rates go down at the short end, the long end will go up as people become concerned that the policies will generate ongoing inflation higher than what we've historically had.
All right, Eric, I have to leave it there. Always appreciate getting your comments here. Eric Rosengren, of course, former president of the Federal Reserve Bank of Boston, kicking us off to the close here on this Tuesday afternoon. When we come back, a focus on the financial sector and big news out just today. A major deal hitting the tapes with U.S. Bancorp set to buy BTIG for as much as $1 billion. A discussion up ahead with the vice chair and head of wealth, corporate, commercial, and institutional banking over at that firm. And from banks to big pharma, we go back out to the J.P. Morgan Healthcare Conference in San Francisco. let's go a sit down with the CEO of Teva Pharmaceuticals, Richard Francis. And we circle back to the health of the U.S. economy and to the Fed and to Jay Powell. Thomas Hoenig, former president and CEO of the Federal Reserve Bank of Kansas City, joins us just a little bit later. A lot more coming up here on The Close. Stick with us. This is Bloomberg. All right, the largest regional bank in the U.S. is boosting its trading operations. U.S. Bank agreeing to acquire brokerage BTIG for as much as $1 billion. It's a push to broaden its investment banking and trading offerings. Joining us live on the heels of the announcement is Stephen Philipson. He's the vice chair and head of wealth, corporate, commercial, and institutional banking at U.S. Bancorp. Great to have you here, Stephen.
Thank you for having me, Ron.
Congratulations on the deal. On one hand, it was kind of a surprise. On the other hand, it wasn't. I mean, we've seen a lot of consolidation in this space, and we've seen U.S. Bancorp really try to build out its trading business. Up until today, your trading business was largely focused on the fixed income space.
Yeah,
what does BTIG bring to the table?
That's correct. So we started building our capital markets business coming out of the financial crisis in 2009. We were one of the only banks to not have a quarterly loss throughout the financial crisis, real position of strength. We brought in a lot of talent and started building that capital markets business, all focused on the fixed income businesses, corporate bonds, loan syndications, interest rate, derivative hedging, commodities. We've grown that into a very large-scale business today, about $1 billion in revenues on a 12-month trailing basis. We continue to have this product gap on the equity side. Lots of our clients, we have over 45,000 corporate and institutional clients, utilize the equity capital markets. They weren't able to do that with us. This gives us that capability across equity sales and trading, equity capital markets, M&A advisory, equity derivatives, prime brokerage, the full suite of products.
Give me a sense here. You've had a relationship with BTIG for a while, about a decade, at least in terms of referrals and things like that. As you sort of try to integrate BTIG into U.S. Bancorp, what does that actually look like?
So it's actually very straightforward in this instance. So, and that's a big thing we thought about when we were thinking about adding this to our product suite. It's a very tough thing to build organically. So we felt it was something we needed to acquire. One of the challenges in acquiring another company in this space is cultural fit. We've worked with BTIG very closely for 10 years. They've been close partners. They were our equity referral partner. If a client wanted to put us on their equity deal, we'd refer them to BTIG. BTIG would execute and share in the fee with us. So we know their team very well. There are over 100 employees at BTIG who work with U.S. Bank on a regular basis. So that typical area of friction, which is that cultural integration, isn't an issue here.
But why now? I mean, why did this deal come about this week?
Yeah, so it's a natural step in the evolution of our capital markets business to add this capability. Why now? BTIG has been growing at a very impressive rate in the last several years. And looking at their growth forecast, they felt it was time that they actually, in order to be able to support the demand they had from their clients, they were thinking about bringing in some growth capital. And so they approached us about providing some growth capital. And then we started talking about, maybe we should take it a step further and actually bring BTIG into the U.S. Bank family.
With regard to expanding out that capital markets business on the equity side here, do you worry at all about some of the volatility that we see in the equity businesses relative to other parts of whether it's just U.S. Bancorp or other banks as well, that maybe offers a bit more stability? Are you prepared to handle that volatility?
Yeah, sure. It can be a more volatile business. One of the things we really like about BTIG is they've got terrific risk management. They've had a capital light approach to their business, which fits in very well in managing that volatility. The other thing about U.S. Bank, when we look at our product suite across the institutional space, we've got #1 market share in the corporate trust business. We've got a huge fund services business and asset management business. A lot of those businesses provide a lot of steady annuity-like revenue that allows you to have a few businesses in there that are volatile. It's a nice balance in our portfolio.
Investors seem relatively comfortable with the price tag, basically $725 million plus, another $275 or so in considerations on top of that here. Talk about how this is actually potentially going to be accretive to both the bottom line and the top line, for that matter, particularly when it comes to fee income.
Yeah, there's a lot of opportunity for growth in these businesses. We've had times over the last few years where we've had clients who would have used us on an equity transaction, but they didn't want to dilute the fee if it was being split with another firm. A lot of clients who will now utilize us for their equity transactions. those are the clients that told us that they were not using us.
Yeah.
There were others that
Yeah.
just weren't comfortable saying that. So we think there's just going to be a lot of lift from having that capability in-house. We'll also have the ability to drive some of our own products by introducing BTIG's clients. BTIG has over 3,500 clients who'll be able to utilize our fund services business, be able to utilize our payments business, as well as some of our capital markets businesses on the fixed income side.
And before I let you go, I do just want to get your general thoughts just here on the state of that business overall, not necessarily just for your bank, but we talk about coming out of last year, particularly that second half of last year, where we saw a real uptick in capital markets activity. A, do you see that continuing? And if so, what's the catalyst that drives that?
We do see that continuing. We see robust pipelines in our businesses. We know BTIG sees something similar on their side. Capital markets are very healthy right now. And one of the big catalysts that we're seeing is just continued M&A activity, which is driving financing across all asset classes, driving a lot of hedging activity. And we expect that to continue here in the new year.
All right. Well, congratulations on the deal. Obviously, catching a lot of eyeballs today. Stephen Philipson is the vice chair and head of wealth, corporate, commercial, and institutional banking at U.S. Bancorp on the heels of that deal to buy out BTIG for upwards of close to $1 billion. When we come back, we stay in the financial space and focus in on earnings out of BNY. They reported a little bit earlier this morning, and investors seem to be pleased with what they heard. We're going to hear from the CFO when we come back after the break. Dermot McDonogh joins the program right here on Bloomberg. All right, welcome back. We're closing in on the start of the earnings season. We got reports out of two big banks today, including JP Morgan and BNY. Those shares higher right now on BNY, up about 1% here after those fourth quarter results. Record revenue, record net income actually jumping about 22% year over year. Those beats over analyst estimates, driven by gains in fee revenue and interest income. Pleased to say joining us here in Studio 2 is the CFO of BNY, Dermot McDonogh. Joyce, great to have you here.
Thanks very much, Romain. Pleasure to be here with you today.
Let's start, first of all, with the growth that we saw in revenue and income. That's driven largely by fees?
It's a mixture. If we kind of take a step back and look at how we showed up to the earnings today, three main things to say. For 2025, it was record net revenues. The firm, $20.1 billion of revenue for the year. That's up 8% year over year. A nice mix of NII outperformance and fee outperformance, so both underneath driving that. We had record net income of $5.3 billion, up 22% year over year. And we returned a 28% increase in shareholders, EPS of $7.40. So all three records for the year for BNY, so very pleased with that.
With regards to net interest income, what's your general house view right now on where interest rates go? And is that going to be supportive of further gains in net interest income this year?
So what we said on the call this morning, over the last few years, we've invested heavily in risk management and narrowing the kind of cone of outcomes as respect to interest rate volatility. We're kind of currently thinking about two to three cuts this year implied by the forwards, and we see kind of a little bit over 5% NII growth. We expect deposits to hold in line relative to where we closed out 2025, and most of our NII performance comes from the asset side of the balance sheet this year. Is
there any concern that if policymakers don't make good on market bets to cut rates, does that change your outlook?
For us, not really. We're close to home. We're pretty neutral to plus or minus 100 basis points. We're in the risk management business, and we feel pretty good about where the outlook is, the strength of the economy, and what's going on.
Well, when we talk about risk management, I mean, we are in somewhat interesting times, to say the least, where a lot of policies out of Washington are driving what's going on in the markets. How do you sort of factor in, I guess, to borrow a phrase from back in the day, the known unknowns, if you will, when it comes to what's happening in Washington?
So look, BNY, It's been around for 241 years.
Congratulations.
We're in the risk management business. Over the last few years, uncertainty has become BAU. So we're in the preparedness game. We analyze a lot of different scenarios continuously, and our outlook for this year is strong. The economy is in good health. The markets have a constructive backdrop going into this year. So overall, we're kind of bullish on where we are from here.
When you look at your custody and other related services, obviously kind of the heartbeat of BNY, we've seen growth there. I am curious as to how much further you can grow that business. I mean, you talk about being around for 240 years. I mean, of course, that also means you're very mature in a good way, but it also means that what type of growth rate can you put on top of that?
I guess to answer that question, I really have to go back to the start of Robin's tenure as CEO. He's been CEO a little over 3 years. As a team, we re-underwrote what the capabilities of BNY were 3 years ago, and we started to give guidance to that effect. Then Robin laid out strategic pillars: be more for clients, run our company better, power our culture. And really, it's the cultural aspect of what we're about is unlocking the transformation which has happened over the last 3 years. 2 years ago, we gave medium-term financial targets. And today, we've updated those targets, raising the bar on return on tangible common equity and pre-tax margin to 28% for return on tangible common equity and 38% for pre-tax margin. So raising the bar quite significantly for BNY.
Robin has also put a big focus on digital assets and expanding BNY's capability to service clients who want a little bit more in that space. Talk about some of the products that you have rolled out and whether they are actually having a material impact on the actual financial results.
So one thing I would say about Robin, as CEOs go, one of the most sophisticated technological CEOs around in financial services at the moment. And there are two pillars to the strategy. One is AI, and the other one is new products and innovation in the digital asset space. We're seeing new digital native clients come to us for thought leadership as we rewrite the financial market infrastructure for the next decade. So clients are coming with us to learn and to grow in that space, and at the same time doing traditional services with us. So we're able to grow both things at the same time. And on the AI, we've been early adopters in AI. The mantra is at the firm, AI everywhere, for everyone, for everything. And that's a strategy that's really been working well over the last couple of years.
Has the implementation of AI internally actually led to productivity improvements within the bank?
Absolutely. It's early days, but as Robin, I think, said on the call this morning, that the AI technology is good, and we're about integrating and adopting at an enterprise level. We have roughly 130 digital employees working side by side with their colleagues, and we have about 150 solutions in place in production, servicing clients in a better way than they were a year ago.
All right, Dermot, great to catch up with you. Dermot McDonogh is the CFO over at BNY. Those shares higher on the back of the company's earnings. This is Bloomberg. 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick. Katie Greifeld is on assignment. She'll be checking in with her in just a minute, a little bit later here in the show. But we focus in on the markets, now trading around session lows, with the Dow down about 1% on the day and the S&P down about 0.5%. Markets participants came into today hoping for maybe potentially a little bit of a boost from the latest read on U.S. inflation. We got a report on CPI, and core CPI did increase 0.2% from November to December. However, that was less than expected. The advance on an annual basis, 2.6%, also slightly less than expected, matching a 4-year low. But if you're looking for a clean read on exactly where we stand with inflation out of this report, think again. Our next guest says this is unfortunately still not a clean read, saying there is still noise in the data due to the catch-up after the government shutdown back in October of last year. Omair Sharif is the founder and president over at Inflation Insights, and he joins us right now to try to parse this report and maybe try to divine exactly where we go next. All right, Omair, let's start off first with the main numbers here. 2.6% year over year, 0.3% month to month. Not bad numbers, but as everyone knows, we've been well above the Fed's 2% inflation target for going on 5 years right now. And while inflation is moderating, it does seem to have kind of hit this kind of sticking point where it can't really seem to drop meaningfully back down to that 2% level. What's going on?
Yeah, Romaine. First of all, thanks for having me today. Look, I think, as you said, it's not a clean read, unfortunately, still. There's a bunch of noise still in this data as we kind of catch up from the government shutdown. What I would say, though, is actually, I think it's when you kind of get through all the noise, we can look at a couple of indexes to get a better sense of what's going on under the hood. So the median CPI, for example, actually rose at about a 3.5% annualized rate today. The 16% trim mean from the Cleveland Fed actually was up around 3.7%. So to me, I think when you get through all the noise of the last several months of data, we're probably still a little bit closer to 3% on core inflation, which is where we were before the government shutdown, than we are to what today's numbers tell us, which is a little bit closer to 2.5%. So despite the fact that there is obviously a ton of noise still in the data, even in this December print, I think when you cut through it, inflation, as you said, it's kind of stayed around this 3% type of reading, and it hasn't really gotten significantly better, despite the fact, by the way, that shelter inflation's gone down and is adding almost half a percentage point less this year than it did last year. So even despite that, we really haven't budged a lot on the overall core inflation figure. I
am curious, when you sort of parse some of the other inflation reports that we get, we're going to get the producer prices tomorrow, and of course, the PCE numbers that the Fed pays a close attention to, I believe, next week ahead of their meeting in 2 weeks' time here. Are we going to see a different story or narrative out of those reports relative to what we got out of CPI today?
Yeah, so look, the BEA is sort of doing something with October. Obviously, we didn't have any October CPI data. And CPI is a big input into how they come up with the PCE. So what they're effectively doing is kind of taking the average figure over the last couple of months where we didn't have data to fill in the blanks, if you will. So that's going to end up kind of pushing down on the October number for the PCE. That's probably roughly, I'm looking at about a 0.2 right now. The November print, given what we've got right now, is probably around a 0.1. High 0.1, low 0.2. December, though, after today's CPI right now is looking like a 0.4. So there's going to be some volatility in the PCE data as well. We'll know a little bit more after tomorrow's PPI readings because that's another big input into PCE. But the way it stands now, and again, these are forecasts, but the way it stands now, it looks like the core PCE inflation number was 2.8% before the shutdown. It looks like we could end up around 2.93% when all is said and done, when the December data finally comes out. So again, very sort of sticky inflation hanging out around 3%, despite the lower impetus from shelter inflation.
Talk about what we saw in the services categories, because there does seem to still be some price pressures, outsized price pressures in that area.
Yeah, look, one of the things we like to do is sort of strip out the shelter stuff, partly because we know it's so lagged, and look at what's called a super core. So that's core services, excluding the shelter data. That was up around 0.3 today, about 3.5% annualized rate. So again, still relatively sticky. And that's even with a very, very large drag today. I don't know if you've checked out your cell phone plan, but apparently the price of that dropped about 3% in the month of December. That cut almost a full 1/10 from the core CPI data today. And that's just not something you would expect to repeat on a regular basis. So when you kind of strip that out, underlying, you're probably looking at supercore 0.5 or around 6% annualized. So again, it is still very noisy. There's a lot of stuff going on in December that we've got to be careful about how we interpret. But at the end of the day, whether you want to look at overall core, you want to look at core services, a super core, it just doesn't look like we're getting, too much relief, despite what some of the top line numbers might be showing you right now.
All right, Omair, always smart as always. I have to leave it there. Omair Sharif is the founder and president over at Inflation Insights. Nice breakdown of the CPI numbers we got today. Reminder, PPI numbers tomorrow morning, and next week we are going to get the core PCE numbers that the Fed puts a lot of stock in ahead of the big Fed meeting on January 28th. When we come back here on the big program on this day, we're going to go back out to the J.P. Morgan Healthcare Conference in San Francisco. The Teva Pharmaceutical CEO, Richard Francis, will be joining us. Stick with us. This is The Close on Bloomberg. All right, welcome back to The Close, a focus on healthcare and a focus on Teva Pharmaceuticals. The company issuing what one analyst called a reassuring long-term growth outlook. Innovation set to become a big part, if not already, of Teva's business in the coming years as it expands. We haven't actually spoken to Katie Greifeld, even though we're 39 minutes into the show. So let's go right to her. She's out there in San Francisco at the J.P. Morgan Healthcare Conference. And I'm told, Katie Greifeld, you're standing by with the CEO of Teva.
That's a lot of adverts.
Indeed, he is sitting right across from me. His name is Richard Francis, the CEO of Teva Pharmaceuticals. Richard, great to see you again.
Great to be here. Thank you for having me, Katie.
So Romain alluded to this in this intro, but you think about Teva, you have your legacy generics business, and then you also have your branded drugs segment. Bloomberg Intelligence calls that your innovation business here. And it's interesting, they have a forecast that when you think about the branded drugs segment, that's on track in their view to outpace your traditional generics business by 2030. Do you agree with that assessment when you take a look at the trajectory?
Absolutely. I do. And actually, I'm glad that your colleagues think that. We've been working hard the last 3 years on Pivot to Growth to pivot the company from a pure play generics company to this leading biopharma company. And yeah, the data suggests that by 2030, just beyond, we'll be 50% an innovative portfolio company, which is a massive transformation and really exciting.
Well, they went one step further. They say when you take a look at the pipeline of your innovation business, it's on track to generate nearly $12 billion in sales by 2035. Of course, it's only 2026, but you think about that timeline there. Does that sound realistic?
Yeah, it does, and actually that's what we've been talking a lot about. And I think the reason why Teva has got some traction recently on our stock the last sort of 12 months, in particular last few months, is around that pipeline. And so our pipeline is late stage. So to your colleague's point, 12 billion by 2035, give or take, coupled with the products we already have in the market that are growing over 30% and nearly $1 billion a quarter already. So what we have is this really unique phenomenon where we have a lot of growth in our innovation. We don't have an LOE in the future, really. It's way in the distance, 2040. And yet we have multiple launches almost year on year. So we've sort of gone on this transformation to a biopharma company, but we've done it at a really accelerated pace. And I'm glad it's getting traction there. And I think that's the excitement we're feeling around Teva right now. And it's been amplified here at the conference at JP Morgan.
Well, before we get to 2030, before we get to 2035, certainly, let's talk about the next few years, because on Sunday you updated your long-term growth outlooks. For 2025, those metrics were pretty much in line. When it comes to 2026, 2027, you were pretty much in line with expectations. Truist, in particular, called them reassuring, which is always a good word to use. So talk to us about some of the different engines of growth that you see specifically in the next 2 years.
Yeah, no. Firstly, I like the fact that, people sort of understand we do what we say we're going to do, and we're very measured in what we say we're going to do. We don't try and overhype things. We don't underplay things. We just get on and do it. And the next 2 years, it's a lot about executing on our innovative products and that pipeline. I mean, 2026 is quite a unique year. We have multiple data readouts. We'll have our duvakitug data readout on maintenance data in UC and CD. We have our anti-IL-15 readout in vitiligo. We have our anti-IL-15 readout in celiac disease. We have a futility analysis in imrisolmin for MSA. We have a readout in asthma, and we launch olanzapine. So that's a lot of exciting data to come out. So we've got to make sure we do that and execute that well. But our underlying business, we've got to keep driving the revenue of those innovative products like Austedo, Uzedy, and Ajovy, which I think have surprised everybody how well we've grown those over the last 3 years. We've got to keep that going. And I think if we do that, keep driving our efficiency programs, 26 and 27 will be excellent years, but they'll set us up for what I think we just mentioned, this pipeline that's going to come through pretty much year on year. We'll have a product to launch, and those products will go on delivering revenue, for 10, 15 years. So very exciting times for Teva.
Well, when it comes to the pipeline, let's talk specifically about your drug application for your schizophrenia drug with the FDA. Is there any timeline that you could share when it comes to potential approval?
Yeah, no, we're really excited about our long-acting olanzapine. There is no long-acting treatment, olanzapine, in the market right now that's used by physicians. And olanzapine is the most used schizophrenia product. It's seen as the most efficacious. And obviously, patients and physicians like to be on a long-acting because they can have an injection once a month, so compliance is good. We submitted that to the FDA in Q4 last year, and so if everything goes according to plan, we'd like to think that we can launch this sort of toward the end of Q3, start of Q4 this year. And don't forget, we already have a long-acting schizophrenia product in Uzedy, which has beaten all expectations already, and so olanzapine will join that. So we'll have what I consider to be one of the most exciting schizophrenia franchises out there right now. So very excited about that, and there's a big unmet medical need.
Well, we'll certainly look forward to approval and then launch. I do want to talk a little bit about your active ingredients business. This is something you and I spoke about in the fall after you announced that basically you're renewing the sale process. You had an unnamed buyer that fell through. Are there any new suitors? Where do you stand in the negotiation process?
So, firstly, nothing fell through. We decided not to do the deal, which I think shows a lot about how Teva's come. You know, I think when we decided to sell that business, that was seen as a big opportunity from how to improve our balance sheet and from an investor point of view. What is interesting, when we decided that deal wasn't right for us on a number of parameters, when we pulled away from it, I think the capital markets thought, one, that's not a big thing because Teva's transformed so much that is not pivotal anymore to their growth story. And the second thing is, these guys are good at custodians of the business. They're not going to do something just because they feel they have to. And so I think it just shows how strong we are now, that we can make decisions in the best long-term interest of the investors and the company. That said, to answer your question, we are going to re-engage the sell process, but we're going to do that maybe towards the end of the year. We're in no rush to do it. The company's on a good trajectory. We've got good growth on the top line, good growth on our EBITDA and on EPS. So we're in a position where we can control those timelines a lot better than we needed to 3 years ago.
Well, Richard, when you do find a suitable buyer, let us know here on Bloomberg. Great to get some time with you. That is Richard Francis. He is the CEO of Teva Pharmaceuticals. Back to you, Romaine.
All right, some breaking news crossing the wire on Netflix. This involving, of course, the bid for Warner Brothers Discovery. We're now learning that Netflix is working on revised terms for its Warner Brothers Discovery acquisition. This, according to people familiar with the situation, and it could include making an offer that is all cash. Joining us right now is Chris Palmeri, our man out in Los Angeles. Talk a little bit more about what we know. We should point out Warner Brothers shares, which had been in the red for most of the day, spiking as we get closer to the close on the back of this news. Chris, what exactly is Netflix considering?
Well, they're possibly amending the terms of their offer. We're not hearing that they're changing the overall price, but they would potentially make it all cash. There was a component about $4 out of the $27.75 that was going to be in Netflix stock. Netflix stock has taken a beating since this whole takeover war began, lost about a quarter of its value. And Netflix sees this as an opportunity to really just sort of strengthen the terms because they're competing against an all-cash offer from Paramount.
So it gets to this idea, though. I mean, I know there's been a lot of discussion about the differences, the financial differences, I should say, in the two bids. Of course, there's been a lot of speculation that the decision might ultimately hinge a little bit more on politics rather than anything not. Do we have any sense here that Paramount Skydance, given that what we learned yesterday about its effort to put a couple of members on the board and, of course, the lawsuit asking for more transparency in the process, might actually sort of make whatever new offer Netflix puts on the table moot?
Definitely not moot. I mean, the big takeaway here is that Netflix is in this. There's been a question mark. They were sort of a surprise bidder to begin with. This isn't their thing, doing these big acquisitions. And so people wondered, how committed are they to this? This is a signal that they're still committed to doing this deal. Paramount from here, as they're trying to get more details about the valuation process that Warner Brothers went through public. They're continuing with their tender offer. If it comes down to a shareholder vote over the deal, they'll oppose that. If it comes down to an annual meeting, they will propose an alternative slate. So that's Paramount's strategy.
Where do we stand right now, Chris? I mean, I know next week we're supposed to get Netflix earnings, and a lot of people, of course, are going to assume that they're going to make some announcement or maybe some clarification on where we stand in this process. But do we have any idea about what the timeline is? I mean, does the board have to vote over at Warner Brothers and shareholders? Do they have to vote on this anytime soon? What's going on?
So Warner Brothers has said that they would put this up to a shareholder vote sometime in late spring or early summer. Their annual meeting historically has been in early May. You could see, we don't know which of those events will happen, and they could happen simultaneously. But over the next few months, Warner Brothers shareholders will get some opportunity to vote.
All right, Chris Palmeri, of course, out there in Los Angeles, helps to cover all things media and entertainment for us. The latest news right now, Netflix said to be taking a closer look at the bid that it made for Warner Brothers Discovery, maybe potentially making it an all-cash bid, though not necessarily raising the overall price. We should point out Netflix shares, which had been relatively unchanged on the day, at one point up as much as 2% here in the session. Warner Brothers shares, which had been flat on the day, up about 1%. No movement right now in PSKY. We'll keep a closer eye on those names as we move closer to the closing bells, which are just about 10 minutes away, on a day where we are most likely going to see most of the major indices end the day in the red, barring some huge turnaround over the next 10 minutes or so. The Dow Jones Industrial Average down about 1% on the day. The S&P down about 0.4% on the day. Not a whole lot of movement in the yield space despite that CPI report that we got this morning, but a lot of activity going right now in the commodity space and when it comes to currencies. You're taking a look there on your screen at oil prices continuing to be elevated on the back of increased rhetoric by the U.S. relative to Iran. And keep an eye on silver and gold. Those haven plays still in play, and relative strength right now in the dollar. The Bloomberg Dollar Spot Index up about 0.2%. The dollar higher against all of its G10 peers, but really it's the outperformance relative to the Japanese yen today that's really catching a lot of eyeballs here. As we move closer to the closing bells, a focus here on economic conditions and really a focus right now on the earnings season. It kicked off earlier today with earnings out of J.P. Morgan and BNY, I should say. We are scheduled to get names out of Goldman Sachs, Morgan Stanley, and quite a few others over the next couple of sessions here. A big question mark here as to whether financials will continue to drive some of the market moves that we've seen over the last few weeks. Let's bring Macrae Sykes into the conversation. He's portfolio manager over at Gabelli Funds, specifically, of course, helping to manage the Gabelli Financial Services Opportunities ETF. Great to have you here, Macrae. Let's start off first with the results we got out of J.P. Morgan and whether they are very, I guess, specific to J.P. Morgan or whether we can extrapolate those results into some of the results that we're going to get over the next 2 days, particularly when it comes to that surprising dip that we saw in the capital markets business, underwriting and fee business over at J.P. Morgan.
Yeah, I think a couple of things to extract from the earnings. I mean, first, you saw a little bit of a disappointment in investment banking. You know, they talked about some delays in terms of, moving because of the events of the closing of the government, et cetera. So stuff kind of moved around a little bit. But, look, I mean, it will smooth out over the cycle here that we have. So we could see some, similar disappointment, but that will be known for, the big banks like Goldman and Morgan Stanley. So I don't think it's a big deal, but something to read through there. And then, their capital markets business was very strong. Expect that to continue. We're looking for kind of a super cycle this year. We're expecting, SpaceX and potentially OpenAI, Anthropic, so a host of IPOs this year to really generate. So I think there'll be some excitement there, even though we have some lumpiness, on the quarter-to-quarter basis.
Well, with regards to that capital markets business and the increase in activity that most people are anticipating for 2026 here, which of the banks, at least the ones that your ETF is invested in or the ones that you cover, do you think stand to benefit most from that upswing?
Well, we're a large shareholder of J.P. Morgan. It's among our top 10. They have a preeminent banking franchise. Then next there would be Goldman Sachs, Merrill Lynch. So those are the names. We don't own Goldman Sachs, but we do own Bank of America. And so those would be, kind of the ones most levered to those. And then, the banking is going to filter down into a lot of the industry participants as well. So I think it's going to be a huge year for capital markets issuance. You do have the M&A backdrop as well, and in terms of deregulation, bank consolidation, et cetera. So there are a lot of things going on that are going to drive engagement as well as issuance.
I am curious of your thoughts on Wells Fargo. We're going to hear from them tomorrow morning as well. And of course, the big focus over the last few months has been the idea of the regulatory shackles finally coming off and what does appear to be a little bit of an impetus by Charlie Scharf to push a little bit deeper into the investment banking side of the business, a business not traditionally associated with Wells Fargo. Sorry, I think we're having some issues with the Macrae's audio. We're going to try to reconnect with him in just a second here. But tomorrow morning, we are going to get Wells Fargo, Bank of America, and Citigroup, three banks with a lot of overlap, but three banks, of course, with very distinct positions right now, very distinct leaderships. Of course, Wells Fargo trying to expand a little bit away or a little bit broader from just its consumer roots here, maybe a potentially deeper push into the investment banking side of the business, apparently now that those regulatory constraints have been lifted. Of course, also a big focus on what Jane Fraser has been doing over at Citi as that company really tries to build out its business as well, and Bank of America. We should point out all three of those names are lower on the day, but that's largely because of the big downdraft that we're getting from J.P. Morgan. Those shares on J.P. Morgan right now down 4% here on the day, setting up for what's going to be one of the worst earnings days performance for that stock, and certainly the worst single-day performance since at least December 9th. A big drag on the broader market here with the S&P down about 0.5% on the day. The Dow Jones Industrial Average down about 1% as we move closer to the closing bells, just about 5 minutes away. We want to bring into the conversation right now our Bloomberg's markets correspondent, Norah Mulinda, joining us here in Studio 2, and Bloomberg opinion columnist Jonathan Levin, who joins us from our beautiful office there in Miami, Florida. Norah, let's start with you here. I'll talk a little bit about the complexion of the moves that we're seeing today, because it looked at one point like we were going to have a little bit of a rally on our hands as a lot of people were pricing in the possibility of more Fed rate cuts on the back of that CPI report. But whatever hopes and dreams we had for that seemed to have faded pretty quickly.
Absolutely. And of course, we are seeing financials. They ended up being the worst performing sector in the S&P 500. But we do know that's a lot of investors and people on the street really trying to dissect what it could mean if Trump were able to actually be able to push forward with a 10% cap on interest rates in terms of credit cards. So you are seeing that being a major drag on that sector more broadly. And of course, we did just get those earnings out of JP Morgan Chase, which you just flicked at just a tad earlier. So you're really trying to see the market dissecting what this could mean for this sector, especially as we're really kicking off earnings season here.
Well, Jonathan, what was your reaction, particularly to the JP Morgan earnings? And I know that a lot of people are going to look at those numbers and say, look, that's probably an anomaly. But we came into this quarter with the expectations that the big banks were going to report record results. They were going to report a huge upswing from capital markets activity and even potentially a huge upswing from net interest income, given the trajectory of rates.
Yeah, well, that's exactly the thing. There are so many high expectations baked into this market. It's not just in financials. It's also in information technology, which has struggled to find any momentum over the past few months. Talking about banking specifically, as you say, it very well could be an idiosyncratic situation. JP Morgan says that some of the deals that had been expected to close in that quarter didn't quite close on time. So maybe we get some positive payback on the other side of that. But it just goes to show you, we're still trading at this 22 times forward P on the S&P 500, and it is hard for companies to keep delivering here.
I am curious, though, too, and when we talk about companies delivering, the economic backdrop, Jonathan, matters. And there was so much focus last Friday on that jobs report, which was supposed to be the first clean read that we had on that since the government shutdown. We had a CPI report tomorrow that was also supposed to be a clean read, though I'm told that it was not. When you look at those numbers that we had today, and I don't mean just the headline numbers, 2.6% year over year, 0.3% on core month over month, but dive deeper into those numbers, Jonathan. Is there a story, an inflation narrative that would give investors any sort of hope that the Fed has the ability to cut rates anytime soon?
It depends how you define anytime soon. But what I'll say is, I think that this continues to be a modestly constructive market for stock market investors, but it doesn't have anything to do with rate cuts. It has to do with the fact that we may potentially be in the throes of a productivity boom. Of course, that was the other big data point that we got in the past week, and one of the most phenomenal productivity data points that we've gotten in years, even decades. So people are starting to whisper about whether or not the AI effects are actually flowing through into the economy, in which case we could see the GDP continue to churn, continue to do well, even in the absence of those rate cuts.
It puts the Fed in an interesting predicament here, Norah, because we talk about this idea of whether you can justify an additional rate cut. You run the warp screen on the Bloomberg terminal, and you get a sense of where traders' heads are at, and is that at least for right now, they are not anticipating any material easing in monetary policy. In fact, you really have to go out to June before we see any material bets for an actual rate cut.
And it's interesting because, of course, I always like to keep my eyes on the real estate market. And we've been getting a lot of news, not only from the administration, Bill Ackman also coming in. Everyone really concerned about affordability right now in this moment as we think about the real estate market, credit cards we've just been speaking about. So everyone really has their eyes in this moment on the Federal Reserve, what's going to happen next. We, of course, are going to have a new Fed head coming in soon, especially as we're thinking about that moving ahead. So there is a lot of pressure and people really thinking about what this could mean in terms of the long-term outlook.
Do you think some of the moves we're seeing, though, Norah, today, I mean, are they tied to the economic fundamentals, or is it a little bit more focused on the politics and other concerns coming out of Washington?
Well, it's interesting because we've really been getting a Mod Podge. If you look at energy, that's the best performing sector group in the S&P 500. We've been talking about all the geopolitical concerns, Venezuela, Iran. There's so many things moving right now. But of course, financials in focus as we're really kicking off earnings season. So there's really a lot right now that investors have to swallow. Yesterday,
we had the S&P 500 with the majority of stocks in the red, but the S&P 500 ended in the green at a record high. Today, a bit of a flip-flop with the majority of the stocks in the green, yet the S&P ending in the red, down about 14 points or 0.2%, 69.63 and change as we wait for these numbers to settle. The Dow Jones Industrial Average losing about 400 points or 0.8%. The Nasdaq Composite down about 0.1%. The Nasdaq 100 down 0.2%. And the Russell 2000 is going to end the day slightly lower, dropping about 2.5 points or about 0.1%. We go back to the S&P 500 with those 262 names in the green, 240 to the downside. And as far as the sectors, 4 of those sectors were in the red. The biggest drag, of course, came from financials. As a group, S&P Financials down about 1.9% here on the day. At the top of your screen there in the green, the biggest contributor to any upside for the S&P today. You're going to find that in the energy space, a 1.5% gain as a group. Consumer staples up about 1% here, showing maybe a somewhat defensive posture when it comes to equity traders here, Norah, on this Tuesday afternoon.
Absolutely. There's really a lot to digest right now, but let's talk about some of the names that ended in the green. I'm looking at Warby Parker here. Of course, we did see shares of this company up about 9% on the day. This is after they got a lift to market outperform from market perform at Citizens. We're thinking a lot about the upcoming release of Google's AI glasses. We really had a focus on Meta platforms today, but we are hearing from Citizens that this could potentially be a tailwind if we think about the implications for Warby Parker here, especially given the fact that Meta Platforms is one of the companies that is talking about potentially doubling production capacity for AI-powered smart glasses by the end of this year. So we're seeing a lot of surging demand, and that should potentially push Warby Parker higher, which that's according to Citizens. But I've also got my eyes on the tech space. I mean, we look at Intel, we look at AMD. These are 2 of the companies that we did see as some of the biggest percentage gainers in the S&P 500.
A 7% rally today.
There's always something to watch with them, but we did get an upgrade from KeyBank. That's what you're really seeing, pushing this stock higher. We see shares of Intel ending up about 7.3%, AMD up more than 6% at the closing bell. But this is an upgrade to overweight from sector weight. Of course, chip makers have largely sold out their server CPU in 2026. So that's really what the focus is today as we're looking at this trade. And lastly, also keeping an eye on Viasat. I mean, we looked at L3Harris. That was one of the stocks that was really in focus today, but it did end up pairing some of its earlier gains. But we did see that William Blair is saying that Viasat in particular might follow suit with what L3Harris did in terms of a potential spin-out plan. We do know that L3Harris just spun out its missile unit with a $1 billion backing from the U.S. Pentagon. So William Blair is essentially betting on the fact that Viasat could potentially do the same.
And I'll just add one honorable mention. Keep an eye on shares of Moderna, 17% rally on the day. Biggest one-day gain for that stock going back to late 2022. A lot of decliners out there, too, as well, Jonathan, on this Tuesday afternoon.
Absolutely, Romain. I want to go first to the credit card companies. Visa, the ticker is V, and MasterCard, ticker is MA, M-A. Trump obviously started this when he demanded that credit card lenders cap interest rates at 10% for a year. Then, of course, on Tuesday, he's out there calling on lawmakers to support legislation known as the Credit Card Competition Act. The industry obviously not liking this. JP Morgan's CFO, Jeremy Barnum, said Tuesday that the bank intends to fight this trend and, quote, everything is on the table. I'll take you next over to Adobe. The ticker is ADBE, downgraded at Oppenheimer to market perform on risks to the outlook. We have Oppenheimer analyst Brian Schwartz saying that the risks include a, quote, challenging operating environment during the AI technology transition, leading to uninspiring and decelerating top-line growth. Again, Adobe down 5.4% on the day. Finally, I'll take you over to the travel space. Royal Caribbean, the ticker is RCL, and it closes down 3.1% on the day. In a note, we have Bernstein raising concerns about pricing declines in January. We also have a generalized drag on those travel stocks, generally under pressure today after Delta delivered that disappointing forecast. So there you have it, Romain.
And I'll just add another honorable mention. Keep an eye on shares of Salesforce. They had actually their worst day going back to 2024. Anthropic unveiling some new agentic AI tools that some people think is going to be a direct competition to some of the products that Salesforce itself has been trying to offer. Meanwhile, we check in on the yield space, and believe it or not, despite that CPI report and despite all of the discussion here about what the Fed does next, yields really didn't go anywhere here. On the shorter end of the curve, you did see a slight drop of about 1 basis point, and on the longer end of the curve, particularly with your 20 and 30-year yields, up less than 1 basis point. So just call it stasis on the day, break even, if you will. The market's there in a bit of a holding pattern until we get some more data, and maybe more importantly, until we get to that Fed meeting on January 27th and 28th. Norah, Mulinda, our Bloomberg Markets correspondent here in New York, and Jonathan Levin, our man down in Miami. We say thanks and goodbye to them as our coverage here on The Close continues. When we come back after the break, a closer look at the state of the U.S. economy with Thomas Hoenig, former president of the Federal Reserve Bank of Kansas City. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A bit of a turnaround Tuesday, but not necessarily a good way for U.S. financial markets. A down day for the S&P 500 and most of the other major indices. Whatever optimism we had at the start of the session, optimism about the potential for Fed rate cuts, it got muddied pretty quickly as people really started to dive deeper into that CPI report and realized, quite frankly, there was really nothing definitive about it. The S&P 500 closing lower by 0.2% on the day. The Russell down about 0.1% on the day, though a lot more activity that we saw today in the commodity space and in the FX space. Silver rallying to yet another record high, that safe haven bid. And keep an eye on Bitcoin actually getting a bit of its mojo back here on this Tuesday afternoon. As far as some of the individual stories, one of the few bright spots on the day was Caterpillar surpassing $300 billion market cap for the first time ever, up about 1% on the back of it being an AI play, believe it or not. A lot of folks looking at the machinery maker and, more importantly, looking at the software that powers that machine and saying that there is an AI story baked into that stock. Meanwhile, J.P. Morgan, one of the biggest drags on the market today after disappointing earnings out of that bank, the first big bank out of the gate. Delta Airlines also reported this morning, and they disappointed as well, providing a forecast that was a little bit shy of what analysts were expecting and raising some concerns that geopolitics is actually constricting inbound foreign travel into the U.S. And Visa also on the back foot once again, down about 4.5% on the day because of that proposal by the Trump administration to potentially cap credit card fees at about 10% at least for a year. And that brings us to our top story, and it is about the state of the economy versus the perceptions thereof. Affordability. That has become the buzzword in U.S. politics, particularly after Democrats won a couple of key elections in November by really hammering on that message. And it's a message that's now too salient for all the other politicians and policymakers to ignore. Even President Trump has taken newfound interest in that issue. Though a trip out in Michigan earlier today to tout his economic proposals, it was long on grievances, as his speeches tend to be, a little short on policy prescriptions. But just the fact that he was even talking about it, that's significant. And it raises a question. Is there an economic program out there from the government that is squarely aimed at the pain points that are most important to voters? It's a question politicians, quite frankly, should work a little bit harder to answer, rather than fall into that trap of the cautionary tale that we saw with the Biden-Harris administration, which spent much of the 2024 election cycle trying to convince voters that the economy was actually better than what they we're actually feeling. Joining us now to talk a little bit more about this is Abby McCloskey. She writes for us here at Bloomberg Opinion, and she has helped to direct policy for at least 2 presidential campaigns, has worked on Capitol Hill, and just all around understands the politics and the economic politics of this nation. And Abby, I do want to start there. I want to go back to the election cycle of November, where we saw affordability really become a big issue, an issue that, at least for a couple of key races, certainly turned the tide. And I do wonder if you see the Republicans, whether it's Trump himself or the Republicans in Congress, crafting a message and, more importantly, policy proposals that can address those affordability concerns.
Yeah, absolutely. They are, Romaine. They're in a bit of a crunch. They started the year with 3/4 of the country thinking that America's going in the wrong direction. And that's after last year, which was really a blockbuster year for the GOP, doing almost everything Trump said he wanted to do. So they did that. They're not super popular. What do they do now? And you're right that affordability spiked as a challenge in the November election. They're taking this seriously. Just recently, the Republican Study Committee released a framework for a second reconciliation package, and it is chock full with ideas around affordability. I haven't had a chance to dig fully into it, but the top lines, they're digging into housing, to healthcare, and to trying to get more money to families via paid leave and the child tax credit and some other tweaks there. So they're taking this really seriously, and they have to, because midterms almost always flip. For the Congress flips for the opposite party. The House most certainly will, which means this is their last big year if they want to get a legislative package through to do it. And I think affordability is going to be the way to grease the wheels for that.
I am curious, though, but which types of issues, or excuse me, which types of solutions they can propose. Obviously, the credit card cap seems to be one that Trump is hanging his hat on, at least for right now. But there are a lot of questions, of course, about housing affordability, student loan relief, other things that, at least for right now, seem to have, I don't know, kind of been pushed to the side.
Yeah. So my take, having read the RSC document, was that there are so many things in there, it's hard to identify what their driving priority will be. And I think for a messaging purposes, you really need kind of some sort of core driving agenda. It can't just be kind of spaghetti thrown at the wall when it comes to affordability. I do know that a lot of the GOP and members in Congress are really hopeful for when April comes around and Americans see bigger tax rebates from the One Big Beautiful Bill Act that passed last summer, or when families start seeing Trump accounts be funded with $1,000 of seed funding or extra contributions private sector companies like Dell might make. So I think there's some hope that already wins are in their favor when tax season and some of these accounts come around. But they have a big uphill climb, and I don't think that they have found kind of what their core message and policy will be, and time is running out for them to do that.
What do you think that should be? Because, I mean, they spent a good portion of last year, obviously trying to get through the One Big Beautiful Bill, but just there was a lot of talk about this idea of economic stimulus and the idea that, we're providing things that are going to create jobs, create businesses, hopefully lower costs for things here. Yet when you look at polling, particularly heading into that November cycle, it wasn't just Democrats who were upset with Trump's policies. You had a lot of Republicans, at least reflected in those polls, that also seemed to be dissatisfied. So I am curious as to what more they can do to actually convince just their base that they're doing something on their behalf.
100%. And, I'm a small C conservative, so this will come as no surprise. But the American electorate has historically preferred Republicans on the economy. And what Republicans have tended to stand for on the economy, at least the last 30, 40 years, has been light tax, light regulation, free trade, and a healthy level of immigration. And the GOP's current tension is that so much of the current MAGA and Trump movement has pushed away from that Republican orthodoxy into a new ground of tariffs, which have raised costs certainly on, not on all goods, but on specific goods that have been affected. I think the tightening labor market is also reflective of some of the, I would say, over crackdown on immigration. And so they've kind of gone against this winning playbook that has given Republicans an advantage on the economy in the past. That is not something I understand, but if I were in a position to advise them, I would suggest some type of returning to the types of policies that have won them favor from the electorate for so long when it comes to economic issues. And I think that's reg reform. It's continuing with tax relief. I would suggest getting the debt under control and schools functioning as they're looking for other ideas.
All right. Well said. And we should point out the clock is ticking. Now, remember, this isn't really a November election cycle. Those primaries are coming pretty quickly for a lot of congressional members. Abby, great to catch up with you. Abby McCloskey writes for us at Bloomberg Opinion. She's also the former director of economic policy at the American Enterprise Institute and has advised on at least a couple of different presidential campaigns. When we come back, we're going to go back out to the to the JP Morgan Healthcare Conference in San Francisco. We're going to catch up with the CFO of AstraZeneca and the CEO of Novo Nordisk. Stick with us. This is Bloomberg. All right, let's get right back out to the JP Morgan Healthcare Conference in San Francisco. Katie Greifeld on the ground, standing by right now with the CFO of AstraZeneca.
Romaine, thank you. That's right. Sitting beside me is Aradhana Sarin. She is the CFO of AstraZeneca. To start, it's great to see you.
Thank you so much for having me.
So when you take a look out to the future, 2030, you've set a sales target of $80 billion. But given that you've had a lot of recent success when it comes to some of your clinical trials, is there a chance that you might bump that number up?
Well, I've got that question a lot at this conference. You know, we set this target back in May of 2024. And I'd say at that time, the consensus, sort of the street estimates were closer to like 67 billion. So it was a very stretched target. And those consensus estimates have steadily moved up as we've announced, like you said, 16 phase 3 positive studies last year in 2025. And we've set up, we're actually pretty well set up. This year we have another 20 phase 3 trials reading out. So if we have anywhere close to the success rate we had last year, you know, we should be even more confident in achieving that ambition. But, you know, there's always puts and takes, some of the pricing and other stuff that, you know, was never forecasted or never foreseen back in 2024.
Right.
So we'll need to take all of that into account. But I think our confidence grows every day.
All right, so we'll see and keep an eye out whether or not there is an update to that figure. But I want to talk a little bit about M&A, of course. That's often a theme of this conference. And you take a look at AstraZeneca. You guys have been known for basically bolt-on acquisitions. That seems to be the lion's share. Do you have any appetite at this point for maybe a larger deal?
So, you know, our strategy in M&A is very clear in terms of, you know, is it within the therapeutic areas that we're focused on, which is oncology, cardiovascular, renal, respiratory, immunology, and rare diseases. Two, can we create more value from the combination, whether it's a smaller company or a licensing or a bolt-on, you know, regardless of the size. And, you know, it's often a question of, you know, when you look at many of the deal opportunities, you say, okay, if you acquired it for X, can you really create value above and beyond that? And also, what do we as AstraZeneca bring to it? You know, is it our global reach? Is it our ability to accelerate trials, et cetera? So all of those need to be considerations regardless of the size of the deal.
Well, one of the things that's out in the ether, which is interesting, is the idea that GSK could merge with AstraZeneca. Certainly there's been some commentary just this year alone. Is that a potential here? Would you ever consider that combination?
Well, I can't comment on rumors, obviously. But
if you could.
No, I cannot comment on rumors.
Fair enough. All right, well, we'll keep an eye out for that one as well. It's interesting, you said earlier at this conference that when it comes to your GLP-2 phase 2 data, that's something that's expected this year. And I wonder, you know, where you see, looking out, AstraZeneca's position in the obesity market, given that you could make the case that it's starting to look a little bit crowded.
Yeah, I think it is. You know, first of all, it's a very large addressable market. And I think it will become probably even larger. Even if you look at just what happened with the Part D and the opening up of the Part D channel for obesity medicine, that in itself increased the total addressable market. But there'll be more indications for some of these drugs. And GLP-1 is just one mechanism. You know, incretins are just one mechanism by which you address obesity. We have an oral GLP-1. All the market today is all injectables. There's no oral in the market. Lilly has an oral in development, which is read out, so they will be the first to market in the orals, and we will probably be second, assuming our phase 2 was positive and we accelerate to phase 3.
Well, Novo is in the market for obesity pills.
Yeah, but in terms of the GLP-1 incretins, they had an approval for diabetes, but not necessarily for obesity, and now they're getting the approval for obesity. But it is a peptide, not necessarily a small molecule. Mm-hmm. So ours is a true oral GLP-1 small molecule, which obviously has different characteristics and bioavailability. But that's on the GLP-1 space. Then we have 2 other molecules which are injectables, but they're different mechanisms of action. One is selective amylin, and the other is a GLP-1 glucagon. And those have different characteristics in terms of tolerability, but also the impact on lean muscle mass or the impact on visceral fat, and that's why we're studying them in phase 1-2, and we'll see how that data reads out.
Absolutely. And this might be a little bit of a curveball, but at Bloomberg, we spent a lot of time looking at indexes. And you think about the recent change announced by the NASDAQ 100 that on January 20th, your stock will exit that index. I'm curious to know, as CFO, what is your reaction to that, whether or not, getting back in that index is a goal for you?
No, so that was kind of anticipated. Last year, we announced this, what we call as harmonization. So we are right now listed on the London Stock Exchange. We're listed on the Sweden Exchange, and then we had ADRs in the U.S. So our ADRs were actually part of the NASDAQ. Mm-hmm. What we announced with this harmonization change is we will actually cancel the ADRs, and we will list our primary stock or our main stock directly on the New York Stock Exchange. So because of that shift, and the New York Stock Exchange listing will happen, sometime in February. So the removal from the NASDAQ is an anticipated event, and they always sort of decide in December and then announce in January. So that was very much anticipated. I don't think that changes at all our trading dynamics or investor interest.
All right, Aradhana, I have to leave it there. Really appreciate your time. I know
Thank you so much.
It's been a busy conference for you. That is Aradhana Sarin. She is CFO over at AstraZeneca. Back to you, Romain.
All right, Aradhana Sarin over there at AstraZeneca. Of course, Astra, a big focus on their business when it comes to oncology and gastrointestinal diseases. We also had a chance to catch up with Novo Nordisk, which, of course, has a big focus on obesity medicines. We caught up with the CEO to talk about the drug maker's new obesity pill and whether it's going to open doors to a new market in the U.S. Take a listen.
It's been really exciting to launch, and I think when you go around this Congress and hear the excitement externally, we are of course subjective, but externally everyone being excited about it gives you a good feeling. The uptake has been good, but it's really early days for me to go into the details of it. But it really speaks to the fact that we also spoke earlier. There's been a lot of people that are excited about GLP-1 category, weight loss, but did not want to take an injection. There's the taboo of injection, there's needle phobia, and they've been waiting. So we are super excited that we're finally having an offering for this large group of people that have been wanting a pill.
And critically, you have a couple months here when it comes to Eli Lilly. They're slated to get approval sometime in the next couple months. How do you prevent your patients from switching to Lilly's pill, which I understand doesn't have exactly the same food restrictions as yours does, once that is on the market?
A couple of points. When we started actually deciding how to go into the oral segment and decided that we should put our protein and peptide and encapsulate it and take that route, most people thought that this is going to be impossible. Scientifically, you don't find examples of a protein, large protein peptides going inside orally and not being dissolved by the enzymes of your stomach. We were able to do that magically, I would say. But now, of course, we're getting the fruits of that. We have, for the first time, the efficacy of our pill at 16.6% when you take the drug, being exactly equal to the pen version of it, the Wegovy pen, again at 16.6%. That, of course, is second to none. When you take a look at the data from all of our competition in late pipeline or early pipeline, no one has that efficacy. That, I think, is a big leap that we will talk to. Not least, of course, Wegovy pill also have the CV benefits that our competition does not have at this point. So I'm incredibly grateful for that. Now, you talked about restrictions. I think there's a lot of drugs that have restrictions, including our own diabetes version of this called Rybelsus, where we have 1.5 million patients on the product and not complaining whatsoever about that restrictions. We have this simple saying of sip and go. So I'm very thankful that we basically have been able to prove that on the market with Rybelsus, and I'm very optimistic that Wegovy pill will show the same.
Let's talk a little bit about production of the pill, because you think about the amount that you need of the drug ingredient for the pill versus the shots. How profitable is it to make and produce the pills versus the shots?
Well, if we could not make any financial gains or profits out of it, then we probably would not have launched it. So we have made a couple of things very clear. Again, it comes back to the skepticism that going the peptide route orally is the wrong one, because no one else has done it, that people first and foremost started telling us it's not scientifically possible. When we proved that right, then they started focusing, well, can you produce enough of it and is it profitable? And we basically tell people that we have produced more than enough of it. That's why we're launching it, and that we are actually going to make a decent business out of this. So I'm very optimistic about this pill as we go forward. And again, the single biggest difference, and people have not understood, that this is not a chemical entity, a small molecule, as almost all pills are. Because of that, you have an incredibly potent, effective pill at hand, which we have uniquely learned how to scale it and, of course, make a decent business out of it.
So let's talk a little bit about pricing as well, because you were one of several drug companies that signed pricing deals with the White House at the end of last year. So you think about Medicare, you think about Medicaid. How much of your obesity business do you think could actually come from those two avenues?
What we have seen recently, of course, the lion's share of the business still is through the insured channels, and I think for a long time it probably remains that.
And that was part of Katie's interview that she did earlier in the day with the CEO over at Novo Nordisk. We now want to go back out to San Francisco, where we actually have Katie live once again in the flesh. And she's standing by with the CEO of Illumina. You're a busy person today.
Here I am again, Romaine. And as you said, I'm here with the CEO of Illumina. His name is Jacob Thaysen. Jacob, great to see you.
Great to see you also, Katie.
So today you came out with your preliminary fourth quarter and 2025 results. Right. And it was interesting. When it comes to EPS, you managed to grow that figure despite pretty flat revenue. And I wonder, how you accomplished that dynamic, what that says about the business.
Yeah, absolutely. Thanks for having me on here. And we had a fantastic end to the year with a 7% growth ex-China in the quarter. And as you mentioned also, we were able to deliver 15% EPS growth for the full year. So a tremendous achievement despite a very dynamic year. We started out the year with some challenges from both a sanction in China. We had NIH funding that was challenging, and of course tariffs that everybody else was also facing. But we made some strategic actions early in the year, and really the Illumina team have done a fantastic job executing in a very dynamic environment. So that is what has really gave us the opportunity to deliver strong performance even despite a very challenging year.
Well, you mentioned specifically ex-China, your results there. Let's talk a little bit about China, because it recently removed its ban on you selling your DNA sequencers in that country. So looking forward, now that you can put China back in the mix, what might that mean for your sales?
Yeah, we are very excited about and have had very good conversations with the Chinese regulators about moving forward. We've seen that, and our customers in China have continued to want to work with us. We are the innovator of the industry. We continue to ensure we have the highest quality of insights, and also our Chinese customers are very excited about that. So now with the sanctions behind us, we are still on the unreliable entity list, so we still need to get that behind us before we feel that there is a full focus on the future. But under the expectations that will happen eventually, we do believe there is a big growth opportunity in China. Like around the world, healthcare is a centerpiece of every sovereign's focus area. Most of the population are growing older, and the cost of healthcare is really exploding right now. And that's where DNA sequencing and using DNA sequencing to go from fundamentally sick care into healthcare is something that can really change how we spend our money in healthcare. And that's what Illumina is helping out with in China, but also the rest of the world.
Well, just to follow up there, so you're still on that scary-sounding list.
Yeah.
I know this is an impossible question, but, I mean, what is the process to get off of that? Is there any sort of timeline that you can model into your estimates?
At this point, we don't have a timeline. But what I can say is that we continue to have very good dialogue with the Chinese regulators. So we're hopeful that we will find a path forward and that here in somewhat in 26 it can be resolved. But at this point, I don't have any timeline on it.
You also mentioned the NIH, and of course, the Federal Appeals Court recently ruled that the Trump administration's attempt to cut research for the NIH, basically that was unlawful. What does that potentially mean for Illumina, given that they're a big customer of yours?
Yeah, so NIH is a customer, but more importantly is that the grants that NIH is putting out there is, of course, supporting a lot of academic research in U.S. And so here in 25, that certainly had an impact on our performance also. It impacted our revenue. It impacted many of our customers. We have spent a lot of time here in 25 to support those customers, make sure they can continue to be successful. So even though it looks better now, there's a better situation we're in. As you're saying, we have more clarity on the future. I think there's still a few quarters before many of these universities and core academic laboratories are really starting to spend again. When that happens, we're definitely ready to help them be successful.
And I also wanted to talk a little bit about M&A because Mizuho strategist Jared Holes, friend of the close, he recently said that Illumina in particular could be attractive in terms of being a target for a large company such as Danaher. Is that something that you would be interested in exploring?
Look, I think the opportunity in this space is tremendous, and Illumina is doing great on what we do today. We have a very strong strategy. We are executing toward it. We have delivered great results, and the opportunity for Illumina is great out there. So I feel we are in a very good position, and we don't need anybody's help.
All right, Jacob, always great to check in with you. That is Jacob Thaysen. He is the CEO of Illumina. Romain, that does it for me. I'll see you on Thursday.
All right, thanks there to Katie. We'll get her back in the studio in a couple of days here after being out there at the J.P. Morgan Healthcare Conference in San Francisco. Meanwhile, let's check in on what the markets did today here. It was a down day here for the S&P 500, a 0.2% drop here on the day, and that was largely because of some significant weakness that we saw in the financials and in the travel space. Earnings out of J.P. Morgan this morning, which kind of surprised folks. A little bit of softness here in the fees that they get from the underwriting business and some of the capital markets activity, as well as slightly elevated costs, though J.P. Morgan's CEO, Jamie Dimon, advising investors to be a little bit of patience, but those shares dropped about 4%, dragging the sector down. Delta also reported earnings this morning, providing a profit forecast that came in a little bit light than what some folks had expected. And keep an eye on dollar yen, the weakest that we've seen the yen relative to the dollar since 2024. And remember, we had a huge rally in Japanese stocks. The Nikkei at one point during the last session was having its best day going back to October, closing at a record high. Remember, those markets going to open in just a few hours. A lot of speculation right now about the potential for snap elections in Japan. This is The Close on Bloomberg. All right, welcome back. President Trump renewing his pressure on the Federal Reserve, calling for lower rates and saying to expect an announcement on a new chair within the next few weeks. Joining us right now to parse, well, a lot going on right now with the Federal Reserve is former Kansas City Fed President Thomas Hoenig, now a distinguished senior fellow at the Mercatus Center over at George Mason University out there in Virginia. Great to see you again, Tom. I do want to start off, and we should just point out that as we bring you on, one of your former colleagues, Richmond Fed President Tom Barkin, is speaking at an event right now, and as most Fed officials, they are talking about the independence of central banks and the importance of that independence. And I'm wondering if you can just reflect a little bit on this, now that it does seem to be a relatively unified call from current, former Fed officials, as well as monetary policy officials around the globe, that preserving Fed independence, in their view, is paramount.
Well, that's not at all surprising. Certainly, central banks have found over time that the research has shown it that central banks that are independent do experience less. Their countries do experience less inflation over the long run. But let's also acknowledge that central banks are, in one sense, political. They are this. They're able to print money as no one else is, create money as no one else is. When money is involved, it becomes very political. So the Fed's always had political pressure. This is more direct. It's more heavy-handed in terms of the more recent events. So I think that's what's caused people to come out in mass and say, wait a minute, this is going too far. This is unacceptable, and therefore you get this very significant reaction to it. I'm not surprised by it at all. I understand it, and I also support the independence of the Fed, but I also am realistic that the Fed is always under pressure from political sides, and sometimes they listen to it more carefully than other times. But the main thing is they're making the decision and not someone else. And that's where the issue is.
But this does feel a little bit different. I mean, in the past, we've seen presidents and politicians try to exert pressure on the Fed, but a lot of that has been, I guess, just verbal jawboning, if you will, to a certain extent. We are talking about the active attempt to remove people from their seats, whether it's Lisa Cook as Fed governor or maybe potentially Jay Powell as Fed chief. Does that not concern you?
Of course it concerns me, because when you have that, it's not just political pressure or influence. It's actually changing the institution itself from one that is, as it is supposed to, deliver very careful analysis, decisions that are thought out as a committee with input from different parties from around the country. And now you want to change that and make it say it's only one person, whether it's the president or the White House or the Treasury, making the call. And so that is more direct. It's more disruptive. And I think one of the other consequences of it that has people worried is that it creates uncertainty. And if this were to go on, it would create uncertainty, and therefore it would, shall we say, interfere with the performance of the economy itself. And that's what people are rightfully concerned about.
Well, let's talk about the performance of the economy. We've had a couple of interesting data points, the jobs report, the first real clean jobs report that we've had in a while on Friday. And then this morning, we got a consumer price index report that I'm not sure really clarified anything. But when you look at those data points and some of the other ones that we've gotten here, I am curious as to whether you see any real need for any changes in monetary policy.
Well, I don't see any real need at the moment. Certainly, I don't see that we should be decreasing rates at all, or the Fed should be decreasing rates at all. First of all, we had a very strong third quarter. It also looks like the fourth quarter will be strong. We're entering 2026 with some tailwind. And then also fiscal policy is still, I think, supportive of the economy. We're going to have a $2 trillion deficit again, and monetary policy supportive of the economy. Real rates are less than 1% in terms of the policy rate. So that's a lot of dynamics. Now, of course, the tariffs are having their effect. They're slowing it modestly and not as much as people thought. But those are factors, and people are concerned about unemployment. But when you balance that out, with inflation well above its target of 2%, it's closer to 3%. And with the strength coming into the economy, it is time to pause and let the economy settle in and let some time pass before they start considering whether to decrease rates or perhaps even increase rates if inflation numbers were to become higher. So it's time to pause and think.
I am curious, though, when we look at the inflation rate and the idea that it has tracked now above that 2% target for going on 5 years, even take out the first couple of years, which we know were really skewed because of the pandemic. But it gets to this idea as to whether we can be comfortable with something that is above, at least slightly above, that 2% target, particularly given the economic growth that we saw last year, the relative strength in the labor market that we saw last year, and corporate fundamentals earnings that seem to be holding up as well.
Yeah, well, and that's fine, except that, over time, inflation eats away at the economy. It has its negative effects. 2% is an arbitrary number itself, but it's well above price stability. And the mandate is for price stability. So when you say, well, now we've got 3%, things are good, let's leave it at 3%, what happens when the economy slows? Will we be willing to accept 4%? Do we delay and have 5 or 6%, and then we go through this cycle that we just went through again? I think you have to be careful in what you accept. Now, I think you could bring inflation down to 2% slowly, systematically, without bringing the economy into a recession. That would, I think, be a better outcome for the country in the long run.
So as they head into that policy meeting in a couple of weeks, set aside all the political issues swirling over them, do you think there is still going to be an honest debate about the state of the economy with the focus primarily on the data and not everything else?
I personally think it will be. I think members of that committee will be conscientious about making sure they're looking at the data, they're looking at the history, they're looking at the outlook, that they're making a clear analytical decision because they know that they're going to be questioned in whatever decision they make by some party who doesn't agree with them. So they're going to be particularly, I think, conscientious this time. Not that they're not always, but in this instance, they know everyone's going to be looking at them in terms of any hint that they're doing other than a very careful analysis. So I'm confident they'll go into this with a very straightforward analytical approach.
All right. Always great to catch up with you, Professor. Really appreciate it.
Sure.
Thomas Hoenig
You
there.
bet,
Absolutely. The former president of the Kansas City Fed, now a distinguished senior fellow at the Mercatus Center at George Mason University. And of course, as we focus in on the economy, we're going to talk a little bit about consumer spending and really about the state of apparel and retail. The CEO at the cross-section of tech and fashion. She joins us in just a second to break down how her company pulled in $1 billion in net revenue last year. Meera Bhatia going to be joining us, the CEO of Fabletics, when we come back after the break. This is The Close on Bloomberg. Athleisure stocks. I didn't know that was actually a category, but the Bloomberg terminal, it has everything. Those stocks as a group outperforming the S&P 500 in the last 2 months, a possible sign of turning tides in a hotly competitive space that's still plagued by concerns about tariffs and still plagued by concerns about the health of the consumer. Our next guest is one such competitor, her company reaching $1 billion in net revenues last year with her activewear business. Joining us right now is Meera Bhatia. She's the president and chief operating officer for the Fabletics brand. Great to have you here on the program. I think I inadvertently gave you a promotion in the tease just ahead. But you're fresh off the stage here at the National Retail Federation's conference here in New York. Talk a little bit about the growth of this company. We talk about a company founded back in 2013, so just a little over a decade old, has already reached $1 billion in sales in what is traditionally a hard market to really gain traction in.
Yeah, we're pretty excited. Thank you. Yeah, we hit the $1 billion mark in net revenue in December. It was a big milestone for the company. But it's really just building on several years and many years of continued sustained success. We had 18% revenue growth last year. We've been expanding our physical retail presence where we've had double-digit same-store comp growth for 3 years in a row. So really, everything is kind of working in the business and coming together.
What's actually driving that growth in terms of how you're marketing, how you're selling, and just generally the overall environment?
Well, Fabletics was originally born out of the belief that incredible leggings shouldn't cost $100, and that's really a guiding principle that has sort of helped us build the business over the last decade. So we've taken that philosophy forward to say that, we really believe that we sit in the intersection of style, quality, and value. And I think it's those three things coming together that has really led us to the success that we've had, because we're really in a good sort of intersection of the three.
And you've done a lot in terms of partnering with celebrities. I think it was Kevin Hart with somebody, and I just saw you signed, I think, your first NFL deal last year. The Bengals, right? Cincinnati Bengals.
Yep. So a star wide receiver. So we've always worked with sort of 2 to 5 big celebrities that really kind of embody style and fashion. We think that helps sort of bring the product to life. So Jamara was the latest. We work with Khloe Kardashian. We have Kevin Hart. We have some new ones coming this year. You'll have to stay tuned. We're really excited about our new partners. But it's a big part of, I think, how we speak to the consumer on an everyday basis.
Well, I bring that up too, particularly with the signing with the NFL deal. Are you positioning yourselves as more of athleisure, meaning just something I would just wear at home, or are you trying to go for performance, meaning people who are actually going to use your clothes for athletic reasons?
Yeah, both. I mean, I think we always were born kind of in the gym, people wearing both kind of like the everyday athlete and the serious athlete. We have kind of product for both of them. Jamar in particular, he's a professional athlete. Yes, he's our first NFL athlete. We picked him because he's an outstanding athlete, but he also embodies fashion and style as well. So we think it's those things that come together. You can look fashionable and style while you go for a 10-mile run, or if you're just sort of like an armchair at home.
You have a lot of retail locations, but to a certain extent, you are kind of a digital-first company. I am curious, and you have a background in tech, we should point out. I mean, before you joined Fabletics, you were at Microsoft, I think, for some years.
Yep.
Was Expedia or something
Expedia,
else?
LinkedIn.
So you have a tech pedigree. How does that help in your job for a retail or apparel brand, I should say?
Yeah, I think that, I mean, the reason I joined Fabletics is we really come from a DNA of a tech-forward business, very data-driven. We invest in our own proprietary technology that fuels everything from our website to our store experiences. That's why it was a fit for me. And, you know, on a personal level, I firmly believe that retail was ripe for disruption with technology for people who knew how to do it right and bring that mindset to the business. And I think that's been a big part of how we've grown and seen success at Fabletics.
Now, give me a sense, though, of how you integrate that, and also just the balance, because you'll talk to a lot of old school apparel merchants, and they'll say that this is a business that kind of comes from the gut. You just kind of have to know what people want and give it to them. And then you have, of course, the data-driven people who say, you know, follow the data, and that will be your guiding light.
Yeah. Well, I mean, I think the answer is somewhere in the middle of that, right? At the end of the day, you can't build a successful retail business unless you have amazing product that people love. So it starts with that, right? Which is having a phenomenal design team, best in the business, that brings product to light. But then we also do read the data. So if you don't know about Fabletics' business model, we are a membership-driven business model, which means customers sign up to become members with us. That gives them access to everyday discounts of 30 to 40% under retail, special product, et cetera. And they can also sort of flexibly be billed for a token every month that gives them access to product up to $100. So I think all of that sort of comes together to drive a predictable data-heavy business, right? So because of that membership model, we have over 75 billion, customer data points that we're processing on an every single day basis.
Do you worry that that membership model, as you sort of grow and get bigger, that membership model might actually sort of hinder that growth? The idea that some people might want Fabletics leggings, but not necessarily want to be a member?
Well, first of all, if they want Fabletics leggings not as a member, they can buy it not as a member. But what we see is that 90% of our customers do want to be members. And 40% of our members have been with us more than 2 years, and half of them say we're their favorite brand, right? So we see a lot of loyalty being driven through that member model. But it's flexible. People can definitely buy with us in other ways.
All right, Meera, it was great to catch up with you. I have to get you back for a longer conversation. Meera Bhatia there, fresh off the stage at the National Retail Federation's conference here in New York, the president and COO over at Fabletics brand. Now, we do want to bring you some breaking news. The president of the United States speaking after landing at Joint Base Andrews in Maryland, addressing the issues with regards to the Fed, saying that he is hearing some of the comments about Fed independence, including comments made by JP Morgan CEO Jamie Dimon, and he will address those lately. He is now speaking about the situation in Iran, saying, quote, in his words, that Iran better behave and that he's consulting with allies about what comes next. He's also saying that he wants Iranian leaders to show, in his words, some degree of humanity. A wide-ranging set of questions and answers coming out of the president there on the tarmac at Joint Base Andrews. We'll bring you any headlines, any breaking news as soon as we get them right here on Bloomberg. All right, we do want to set you up, of course, for what to watch tomorrow, and that includes a slew of earnings. Bank of America, Wells Fargo, and Citi reporting before the opening bell tomorrow. Fresh economic data on retail sales and producer prices as well that could round out the narrative. A look backwards from the Fed's release of its Beige Book survey of regional economic conditions, and a slew of Fed speak tomorrow out of Myron, Paulson, Kashkari, Bostic, and Williams. And a close eye on the Supreme Court. It is Opinion Day with a close eye on a potential ruling on tariffs.